Hi, this is James Eng of Old Capital, and this is the October 2022 multifamily update on the financing and investing side of the multifamily world. So let's jump into it. So we're going to get into this tunnel and figure out what the light at the end of the tunnel is here for multifamily investors. So, let's just start out with some of the macro stuff that we're seeing. PPI came out this week, high 8.5, and I think CPI came in at 8.2 this morning. And that is just going to keep giving the Fed more reason to keep cranking on the federal funds rate, right? So federal funds rate really in September got up to about 3% as their target rate. And really, this is restrictive territory now. So September, October, November, November, people are expecting about 75 basis points, and then December, probably another 50 basis points. So as inflation keeps going up, federal funds rate is just going to keep going up, even though everybody has said there's a lag between when the federal funds rate goes up and impacts to inflation. They're just going to keep cranking, it seems like, on the federal funds rate, which drives SOFR up. So this was a new website that I found called FedWatch that the CME group puts together, and it basically gives the probability of how much the Fed is going to hike, right? So this was done about a week ago, but federal funds, probably right now is probably 90% going to be in this 375 to 400 basis point range, and in December another 50 basis points, so in the 425, 450 range. And so this is where most people are projecting it sort of topping out is sort of 475, and then potentially even up to 5% on the federal funds. So neat tool that I thought was out there to share with you guys, the Fed Watch tool. All right, so what does that all mean? The federal funds moves, but then the big thing that really drives it is the SOFR forward curve. This is going to impact everyone who is on floating rates. So bridge loans out there, and then also Fannie and Freddie floaters out there. So, majority of 2023, they see this above really 4.5, and then potentially coming down towards the end of 2024, back to sort of the neutral rate of 2.5. So forward curve has moved up a little bit, but not as big of a jump from August to September. So from September to October, still sort of north of 4 for the entire year of 2023. 10-year Treasury has definitely made a move over the last month. We were sitting around 3.5, and now, we touched up against 4 earlier a couple of weeks ago, and now we're back right around that 4% range. So 10-year Treasury hovering anywhere from 3.9 to 4% right now. And how this impacts buyers, right? So the inflation's high, the interest rates, SOFR and 10-year Treasury are high. So for buyers, it's hitting you, debt service is increasing, your interest rate caps are increasing. And then this is the big thing to me, is harder to refinance out of these bridge loans, right? So when your bridge loan was done, you maybe were thinking, okay, maybe we'll have a 5% rate, maybe 5.5, but nobody was really anticipating exiting at a 6% debt or 6% interest rate. So that just makes it harder and harder to refinance into agency loans right now. And so what we're seeing is the impact to sellers right now. There's not that much inventory on the market. At the beginning of the year, you might see 30 or 40 deals listed in DFW. Right now, it's probably in the single digits in terms of deals that are listed right now. And even those deals that are listed, there's not that many tours and not that many buyers. And so what you're seeing is it's definitely the buyer's market right now, and cap rates are expanding. So cap rates are going up, and we're still trying to figure out where that equilibrium is. But as buyers are making offers, the 10-year Treasury keeps going up. So it makes it harder and harder to underwrite, makes it more difficult as you put more and more equity into these deals. So this is probably the biggest thing that is sort of one of the effects of higher interest rates, is that if it does lead us into a recession and there are job losses, then what is that going to do to demand for apartments, right? So on one side, you look at the left-hand side, and RealPage put this out, and one of the things they look at is absorption, right? So how many units are constructed, and then how many are actually absorbed. And so this is net absorption. So this is really looking at, for the first time, seeing a negative absorption in the third quarter. So second and third quarter usually are pretty strong. I think a lot of people are moving during the summer. And so the third quarter, if you look historically, let's say pre-COVID, it was a pretty strong quarter, right? So third quarter is pretty strong in 18, 19, and the fourth quarter is usually a little bit more negative. But the third quarter this year was negative. So that's they said, look, it's stemming from low consumer confidence, just nervousness about the economy. So even though people haven't necessarily been laid off yet, they feel it in, whether it's the stock market, they feel it in maybe their company's hiring policies. And so that's driving this demand down. And so when you don't have as many people coming in the leasing office, it's harder to push rents, right? So this month we saw rents sort of finally slow down and essentially be flat on a national basis. And so, people are definitely watching the unemployment rate. The Fed's watching it, and investors are watching this. So right now it's still around that 3.5, 3.6, 3.7 is the official unemployment rate, and then about 7% for the people who I guess are discouraged and underemployed right now. So this is one of the things that, interest rates, obviously it impacts you as an investor, but then it impacts people, companies hiring, and thus demand on apartments as well. So another thing to look at. All right, so this is the tunnel that we started with at the beginning of the webinar. And so what is the light at the end of the tunnel for investors who have been sort of struggling to get through the deals right now? And it is essentially the Fed cutting these interest rates, right? And so that is the light at the end of the tunnel. That's what everybody is waiting for. If you're on a floating rate, if you're buying interest rate caps, people are waiting for these interest rates to be cut. So I'm going to share a couple slides that came out sort of over the last couple of weeks from Pinsford. And so the question is, when will the Fed cut, right? So they looked at a couple of historical charts. One is the length of time from the very first hike to the first cut. And if you look at the past couple of them, it's 1.5 years, the past 93, 99, 2005 was 3.2. And this is the length between the first hike and the first cut. And so on average, it's about 2 years, right? So the first hike this time around was March 2022. And if you average it out, it'll be about March 2024. So that's one data point. Okay, second data point on the right-hand side. So after the last hike, how long do they start cutting, right? So last hike, everyone's expecting, if you go back to that chart, sort of the forward curve, the last hike, people are expecting sort of, early next year. So let's say March of 2023. And so on average, how long does it take before they start cutting, right? So you see these, flat periods on the federal funds. And essentially that's when you're just leaving the rate as is, right? So if you go up to 4.5%, let's say, for example, and they just leave it at there, how long can they leave it there before they have to cut, right? And so the shortest time was 5 months and the longest was 14 months, right? So on average, about 9 months. And so if you're anticipating the last hike to be, let's say, March of 2023, you give it 9 months, that puts you in December 2023. So those two data points say that all of next year, you're essentially, 4.5%, and then you're going to see a cut, hopefully, at the beginning of 2024, if this thing doesn't break, right? So that's the two data points that I want to give you in terms of when will the Fed cut. Now the question is, all right, now that we're at 4.5%, how much will they cut, right? So if you look at the left-hand chart, it basically says, all right, here we are today, 3%. And then in all these previous cases, these people are anticipating, sort of a slow, here's the forward curve, right? So here's what we were looking at before. So 3%, And then your forward curve is really not, it's going up, and then it's sort of this slow wind down back to 2.5%. But this is over like 60 months, right? So 5 years. Whereas if you look at the historical average, once that first cut happens, essentially this historical average comes down even faster, right? So people are anticipating this to come down faster than the forward curve, right? So the market's believing that this is going to be flat for a long time, but it's going to come down faster, right? So what does this tell me as an investor? Obviously it's very difficult if you're in floating rates right now. If you're trying to buy a deal with floating rate debt, it's obviously very expensive. But the moment that the Fed cuts or the Fed stops, that'll sort of be your signal that the light at the end of the tunnel is coming. And this will help hopefully get interest rates down, inflation down, and hopefully when you're going back to this chart, it is not impacting you too much, right? So that is a balance that the Fed is trying to make, is that yes, we can get interest rates back down, but we don't want to go into that deep of a recession. So that is a trade-off. So what are apartment investors doing right now? So here's a couple of snapshots. This is probably in the last 2 to 3 weeks. And pretty much, when you do a new loan, you don't know what your leverage is going to be, and you don't know what your interest rate is going to be. There's been a lot of volatility on the bridge side, a lot of volatility on the Fannie Freddie interest rate side, with the 10-year treasury moving up and down. And so guess what? Loan assumptions are the new thing. So deals still got to be sold. People still have to move properties. So here's a couple of, Texas City loan assumption under 3.5. This portfolio is called assumable 3. This one at 3.54, 60% leverage. In Tennessee, this is another one, 3.52, Freddie Mac loan assumption, right? So those loans, those fixed rate loans that you did at 3%, those are worth a lot of money right now. And so people are willing to step into those loans. Buyers are willing to step into those loans. They know exactly the loan amount. They know exactly the interest rate that they're going to get, and they can underwrite that deal, right? So that's the challenge for a lot of buyers right now, is I don't know what to underwrite. So they're underwriting a lot higher interest rate and a lot lower LTV. And that's basically not getting to the price that the seller wants to get to. So we're seeing a lot of loan assumptions right now that we're helping with. These were a couple that were out on the market right now. The other thing that we're seeing, so that's on the sell side. So if you're on the sell side and you have a good loan in place, that might be a way for you to sell your deal right now. Whereas before, pretty much everybody was doing bridge loans and you had to pay the penalty. Right now, those loan assumptions are great things. The other piece of it from the buyer side is 1031 exchanges. So this was just in the last probably week. We've seen multiple people who have sold properties this year, and they're looking for 1031 exchanges into Texas, into pretty large deals, whether it's 30, 40, 50, $60 million. So these brokers are looking for 1031 properties to come out and buy. So these guys are motivated to get stuff done. So those are the other guys that are closing deals right now. So so we hit sort of the economic and sort of multifamily market update. Now we'll jump into the financing market right now that we're seeing. So in terms of my background, born and raised in Houston, went to school in Austin at UT, and then lived in DFW since 2006. Was an underwriter sort of through the great financial crisis, 2007 to 2015 at G Capital. And then since then have originated close to $1.5 billion in loans over the last 7 years at Old Capital, and then invested in a number of properties across all the major metros in Texas. So so a lot of people ask me like, why multifamily still, right? And so a couple of things that I want to highlight. These leases are getting reset every year. So in an inflationary environment, that's good for your rents. And then if you're able to essentially purchase at a higher cap rate right now than you have in the past couple of years, and then also get good debt on your property, whether it's a loan assumption or even still doing a long-term Fannie Freddie loan right now, I think in the long term, you'll be fine. In the short term, it's a little choppy, but in the long term, you'll be fine. And so really focus in on this cash flow piece and be patient with your money. And I think a lot of people they've been a little bit spoiled with the amount of return that they've gotten over the last, let's say, 3 to 5 years, so quickly. And so I think it's going to be back to, focusing on operations, focusing on the cash flow of these properties versus just the compression of cap rates right now. All right, so where's the opportunity? A lot of sellers, they're going to be motivated if they have floating rate loans. Some of them bought a cap, some didn't. So if they don't have a cap, they're going to be very motivated. Even if they did buy a cap, they might be into their business plan. And if they're not able to hit that, exit, then it's going to be pretty hard to refinance, right? So if they're not able to hit that debt yield that they want to hit, they can't refinance. Versus getting foreclosed, they would most definitely rather sell it before that happens, right? So, here's a deal that was listed this week, essentially in October of 2022, and the previous owner had bought it in September of 21, right? So, with a bridge loan. And so I'm not saying that this particular person has this issue, but most of the time your business plan is not to sell a deal within a year, right? So I think we're going to see some of these deals done in 21 and 22 where if you didn't, raise enough capital, if you didn't set your debt correctly, you might be running into some issues. And so there's some opportunities there for sure. Also on the motivated sellers, these interest rate cap escrows, the cost of these interest rate caps have gone up a lot. So you might see, 5% of the loan amount just for your interest rate cap at 2.5% on a strike. And so it's becoming increasingly higher. And so those are going to be escrows that you have to do monthly. And then the last thing is really sellers with a lot of equity, and they have these fixed rate, whether it's Fannie or Freddie loans, that can be assumed at 3 or 4%. That to me is an opportunity to go in, just buy that deal and get on the good side of inflation, right? So the money that you're paying back every month is with cheaper and cheaper dollars, right? So, but your debt costs are fixed on that. So I think that's where the opportunity is. If you're a current owner, I think your job right now is not necessarily to go buy 10,000 units in the next 12 months. I think you got to be looking for those opportunities, but also you don't want to become a forced seller, right? So you're obviously not going to make the best on that investment, and you want to protect your principal of your investors and yourself, right? So definitely conserve cash for these higher debt service. If you've got higher interest rates on a floating rate loan, save some money for the interest rate cap replacements. And then if you are short on that bridge loan and you're trying to get to agency, having that cash available to hit that refinance. And then in order to avoid, it's very easy to send out money. It's very difficult to call back and ask for the money back. So right now I'm seeing a lot of general partners just sort of conserve cash and limit distributions if they have any sort of floating rate debt, whether it's Fannie Freddie floaters or bridge loans. So conserve cash for that. And then you got to be prepared for, I think there's going to be some opportunistic purchases coming up. And I think the general partners who are going to be able to raise money for these deals, I would say you've got to over communicate with your limited partners on your existing deals and potential future deals so that they're ready to go. And then choosing your debt wisely, and then also your partners, right? So the market's done really well in the last, 5 years. And so, when things are going well, everybody's happy, right? But now where it's, sort of tougher sledding a little bit on these deals, it's you have to choose your partners wisely, right? You want to be with other well-capitalized buyers and partners on these deals, because if, you have a problem with a deal, that's going to take all your attention, right? So choose your partners wisely. And, a lot of these deals that we're seeing right now that get under contract, they're not necessarily, on market for 3 weeks, and then there's a call for offers and best and final and all that. A lot of these deals are, this guy wants to sell for $30 million. You put together an offer, put it together LOI, go tour the deal, and then they're getting, done, negotiated, signed off market. So you've got to know who's out there looking for deals in terms of brokers, in terms of sellers, and then be sort of high on that list as a buyer. And then this last thing might come into play as well. If your loan gets cut or your interest rates are higher, the seller might stay in the deal with you, right? So they might be part of the equity solution as a limited partner in order to maintain the sales price, in order to make sure you close. So those are some of the things on these opportunistic purchases. Right now, it's sort of a trickle right now, but we might see more and more of these deals come out over time. And so I think the interest rates have gone up so fast that it's moved a lot of things, but we'll have to wait and see how that plays out. But it'll be good to be ready. All right. So on the financing side, we really, the bank loans have moved up, closer to 6.5%, 7% on the recourse bank side. Freddie SBL is still closer to 7% right now on fixed rate. And then Freddie and Fannie conventional are closer to 6% right now on their fixed rate. And then non-recourse bridge, you can do some lower leverage non-recourse bridge at probably 250 to 300 over, but majority of the non-recourse bridge is significantly higher. So closer to 400 to 450 over, which is going to put you at, 8% or so on the non-recourse bridge. All right. So on the recourse bank side, 6 to 7%, we're still getting these deals done. We've probably in year to date for Old Capital, we've probably closed about 15% of our loans on the recourse bank side. And, these are deals where guarantors are putting down, 20, 25%. They're signing personally. So if something does happen, they are responsible. And you're able to get a little bit higher leverage, let's say 70, 75%. And then the big thing here is just your legal fees, closing costs. You don't have to buy an interest rate cap, and your rate's fixed for 5 years typically. And it has a step down prepay. So in a sort of volatile interest rate environment, this helps sort of knowing your interest rate right up front. This was a deal that we closed 5-year term, fixed rate, 18 months IO, and then it's open prepay. So that definitely helps. And we got the deal essentially approved in about 2 weeks. And then it was just subject to, your typical third parties. All right. So Fannie and Freddie, a lot of these deals right now are probably closer to 5.5 to 6%. I think this slide is a little bit out of date, unfortunately, on the right-hand side. But spreads are about that 180 to 220 over. So if treasuries right now are 390, you're probably still in that 575 to 625 range, depending on your prepayment penalty. And so a couple things on here. So if you're doing a Fannie Freddie floater, make sure your SOFR rate does not have a floor. It depends on, the loan agreement, but check your loan agreement to see what the floor is on SOFR. So if we said, like, as we saw, if the federal funds does come down significantly, SOFR comes down significantly, you want to benefit from a no floor on your SOFR. And then, we're looking at a lot of exits right now out of Fannie and Freddie and converting it from floating to fixed. And so a lot of times, if you have a Fannie Freddie loan floater right now, you can convert it to fixed, and they'll typically waive your exit fee. And then, we didn't really talk about sort of all the stuff that's going on in the UK right now, but that's definitely impacting banks and their ability to lend. And so Fannie and Freddie are definitely a backstop right now for multifamily compared to a lot of other property types. This was a deal that we closed sort of down near Austin and Temple. Fannie Mae, fixed rate, 10-year fixed, 3 years IO. This one was probably about 60% levered. And that's where we're seeing a lot of Fannie loans land nowadays. All right, bridge loans. So I saw this out of a deck, and I thought it was a pretty good explanation of how these bridge loans are put together. So, you might do a 70% loan to value, first mortgage. That loan, after it closes, essentially is funded on a warehouse line. And then from that warehouse line, it is securitized, right? So this was a process that, 2021, 2022, beginning of 2022, this was happening every month on a lot of securitizations, right? So the money was pretty cheap, and there was a lot of people buying this paper at the securitization. And the problem, though, is that this market has sort of frozen up a little bit. And so it's making everything more expensive, right? So if the securitization is more expensive, then the warehouse financing is more expensive, then your spread here is more expensive, right? So we're seeing spreads anywhere from 4 to 5%. And so your starting rate is closer to 7 to 8% right now. And then they're looking for a higher debt yield, right? So your debt yield is your NOI divided by your loan amount. So they're looking for higher debt yields just because you have to refi at 6%, right, on Fannie and Freddie. So bridge loans are definitely still out there. Loan to value is probably 65 to 70% right now. But you have to be prepared for this, and you have to be prepared for your interest rate cap. So your interest rate cap is going to be anywhere from 5% of the loan amount to 6% of the loan amount for a 2.5% strike. So be prepared for the higher interest rate cap in order to fix that rate for the next couple of years. This was the deal that we did, Meadows in Dallas, non-recourse bridge, full term IO, 3+1+1, and then they have a 1% prepay. So that deal closed earlier this summer. All right, so this is what everybody is trying to get to. So how do I go from my bridge loan to an agency loan? And as this 10-year treasury, so in August, we should have refinanced everything if we could. But right now, 10-year treasury has run about 100 basis points since that low point in August. And so it is pretty difficult to underwrite anything right now to a 6% agency loan because they're looking at a 125. But there will be a time when 10-year treasury comes back down and you will have a little bit better opportunity. And so what we're doing for a lot of people is really sizing their loans up, figuring out what the 125 debt service coverage looks like, and then figuring out sort of what that gap is, right? So, right now, most people are maybe 12 to 18 months into their bridge loan. And what you want to focus in on is really a strong net rental, strong T3 on your net rental to drive the proceeds up as much as possible. And then when the 10-year treasury comes down a little bit, be able to either do a floating rate Fannie Freddie, which will drop your spread in the 2s versus the 3s and 4s, or just fix it at 5% and just sort of ride out this if there's a recession here, be able to ride it out with longer term debt. All right, so YO Capital, we work in all these different different loan products. So Fannie, Freddie, Bridge, CMBS, HUD, construction. But besides that, we do the podcast, we do our conference that we just had last month. We do our speaker series, lunch and learns, and really connect everybody within the space. And so I think one of the things that we're doing right now is really people that we're talking with, whether it's sellers, whether it's listing brokers, like really putting together those key components of the deal and finding, the 2 or 3 people that would be the best buyers for these deals. And so I think anything that you have a question on, definitely reach out to us, let us know. We can help you sort of put the deal together. This was a deal. We were out in Garland doing a property tour with about 30 or 40 folks looking at, Class B properties. And so I think, while there isn't as many deals out there right now, it is good to sort of get your education up. So if you're interested in coming out to the next property tour, we'll probably have one probably middle of November before it gets too cold here in Dallas. Send me an email and we'll put you on that list and let you know when the next one is. All right, Q3 for Old Capital, we did about 300 million or close over 300 million, 30 plus loans. So, Class A stuff in McKinney, all the way to smaller deals down in Oak Lawn. So we can work, 286 units down to 14 units. So any deals in that range, so definitely let us know if we can help you on refinancing or acquisition loans out there. So yeah, next steps. Subscribe to the YouTube channel definitely helps me and gets more people in front of the channel. If you need help with a loan term sheet, just send me a T12 rent roll OM whisper price on the deal. If you need help reviewing a package, you can send me that. I'll take a look, give you a few comments on it. And then if you're just getting started, you can complete your PFS and set up some time to talk from there. And then if you're interested in joining Old Capital or being part of our team, send me an email with your resume and sort of what you're looking to do, and I'd be happy to talk with you from there. So I appreciate it. If you like this video, definitely like the video and subscribe to the channel. Thanks a lot.